Good afternoon, everybody. We've got a couple more people joining, but we're thrilled to have everybody with us today to discuss the Provider Relief Fund reporting period 2, as well as the Phase 4 and American Rescue Plan payment updates. All right, so we will go ahead and get started. Just as a note, if anyone has questions as we're going through the webinar, feel free to put those in the Q&A, and we'll try to get to those as we're working through the deck. We're going to start off with a review of the Provider Relief Fund to kind of refresh everybody's memory on what we're talking about here. We'll next talk about the reporting components and process. For those of you who may have reported in reporting phase 1 back in the fall, there will be some review there, but always helpful to refresh everyone's memory. And then finally, we'll talk about phase 4 and the ARP rural payments, some key issues to have in mind there before turning it over to Amber for discussion of our audit considerations. All right, so what is the Provider Relief Fund? Again, as a reminder, this is sometimes called the HHS stimulus. It was created through the CARES Act 1 million years ago in the spring of 2020. And the goal is to provide financial assistance to healthcare providers throughout the COVID-19 public health emergency. These funds can be used to help providers prevent, prepare for, or respond to coronavirus. And they're intended to reimburse providers for incremental healthcare related expenses and lost revenue attributable to coronavirus. As many of you are probably aware, the guidance related to the use of these funds has been extremely fluid, often very ambiguous. And as the program has evolved, things have changed pretty dramatically. So certainly a lot of complexity to have in mind here. One quick update piece related to kind of current buzz on the Provider Relief Fund. There is a lot of lobbying activity right now with the hopes of both emptying the current appropriations for the fund, distributing the rest of the money that remains, as well as to increase the amount of money in the fund. So lobbying groups are lobbying Congress to appropriate additional funds. There's also a bill before Congress that would relieve some of the reporting requirements that have been imposed as part of this fund, which obviously we'll discuss today. While that is in process, I wouldn't necessarily hang your hat that that is going to go through before March 31st, before this next reporting deadline, but it's certainly something we have our eye on. So a quick timeline overview, again, just as a bit of a refresher. This all goes back to April of 2020 when Medicare providers received an automatic distribution into their bank accounts, most people on April 10th of 2020. Going into that summer, there were additional general distribution payments, as well as the first targeted distributions, which we'll talk about today. There is some complexity there when it comes to reporting. Going into the fall of 2020, eligibility began to broaden. So while the first tranches of the distributions were really focused on medical providers, going into the fall of 2020, eligibility for dental providers, behavioral health who don't accept Medicare, Medicaid, as well as assisted living facilities, all came into scope. Going into fall 2020, winter 2021, payments for phase 3 of the general distributions were made. Many of these were rather sizable payments. They were based on losses in the first half of 2020, which obviously were also sizable. Going into this past spring, summer, there really was not much activity. There was about 24 billion remaining in the fund and not much movement until fall of this past year. So in September, we had the first reporting deadline pass for providers who had received funds between April 10th, 2020 and June 30th of 2020. There was also a deadline in the fall for phase 4 and the ARP Rural Distribution which have begun to be paid out starting in December. And for any of you who applied and may not have received anything yet, no news is good news. So HHS is issuing letters to providers who will not be receiving anything. So if you have not heard either way, it's our understanding that HHS is still in the process of reviewing applications and making distributions. All right. So going into reporting components and process. As a reminder, based on when you received the funds, there are different reporting periods and different periods for use. In terms of periods for use, periods of availability, all distributions, whether you received it in the first half of 20, whether you received a payment last December, in December of 2021, the period of availability for all distributions begins on January 1st of 2020. So all of the periods of availability overlap, but depending on when you receive the payment, you may have a longer period to take advantage of the funds. So for the current reporting period, those are for funds that were received between July 1st of 2020 and December 31st of 2020. The period of availability for those funds, again, begins January 1st, 2020 and ran through December 31st of 2021. And the reporting timeline, you have until March 31st to complete reporting. As some of you may be aware, in the fall, HHS extended the deadline, offered a grace period between the September 30 deadline and when they would begin enforcement activity. I would not bank on getting such a dispensation this time, so I highly recommend getting everything done by March 31st. And we'll talk about some of the lessons learned in terms of the amount of time that reporting can take. So as part of the phase 2 of reporting, we are going to have some of you who are returning, who reported in the fall, and some of you who are net new to reporting, who have not yet had to submit anything. So for returning reporters, this again applies to folks who received PRF payments before June 30th of 2020 and who reported in the fall of 2021. For these reporters, most previously submitted information will be pre-populated. So when you go in to update your lost revenue through Q3 and Q4 of 2021, what you entered through Q2 of 2021 will already be there. Now, providers who already reported will have the opportunity to update figures that they had previously submitted, so expense figures, et cetera. There is some speculation, nothing in writing, that making a change may raise flags with HHS in terms of, drawing additional scrutiny. Our opinion, the most important thing is to have accurately reported figures. So if for some reason systems were updated, a report was pulled incorrectly, and you find that a number you entered in the fall really is not the correct number, it seems to us that the best course of action is to make sure what you're submitting is as accurate as possible, ties to your records as closely as possible, rather than just not changing it out of concern that it might draw HHS's attention. Importantly, if you are considering changing your lost revenue approach, so we'll talk more about this for the new folks, but there are 3 approaches for reporting your lost revenue. If you are interested in changing your approach, you do have the option to do that. However, that will change your lost revenue calculation for the entire period going back to the first quarter of 2020. So you can't mix and match. You can't use an actual to actual comparison for the first phase of reporting and then switch to an alternative methodology for phase 2. So that's something to bear in mind. If you are looking to change your methodology or to change the revenue figures you submitted, again, numbers change for whatever reason, you will need to submit a narrative explanation of why you are doing that of up to 1,000 characters. Just again, as a FYI. For new reporters, so this is for folks who did not receive any money until July 1st of 2020 or later, and before December 31st. There are many new provider types, as I mentioned: dental, behavioral health, assisted living. If you fall into one of those categories, as we're going through the reporting components, it's important to bear in mind that HHS has really geared the definitions of the data they're looking for towards medical providers, physician practices, hospitals, et cetera. So when you're thinking about applying your own data to these same categories, there is a need sometimes to find what is the best category, given that I may not be a medical provider. And we'll look at more about that. For providers who did not report in September, you will need to provide data for the full period of availability. So you are going to be providing data going back to January of 2020 for expenses and back to January of 2019 for lost revenues. So unlike the returning reporters who are just updating their reports for Q3 and Q4 of 2021, you will be going back to the first quarters of 20 and 2019, depending on which element of reporting we're talking about. Okay, targeted distributions. Reporting period 2 is going to include far more reporting on targeted distributions than reporting period 1 did. There's a lot of additional complexity here if your entity received a targeted distribution, and particularly if you have a subsidiary that received a targeted distribution. As a reminder, there are kind of 2 chunks of targeted distributions. One we've categorized as other targeted distributions, and the differentiating factor here is what you can use these distributions for. So the other targeted distributions really behave like the general distributions. You can use it for any incremental expenses or lost revenues due to coronavirus. The nursing home infection control targeted distributions can only be used for infection control expenses. They cannot be used to cover lost revenues. So in terms of kind of these other targeted distributions, those were high impact hospital payments. There were direct payments to skilled nursing facilities, safety net hospitals, rural hospitals, and Indian health services. Nursing home infection control obviously went out to nursing homes. The types of expenses that you can use there, costs associated with testing, with reporting test results, hiring staff, infection control mentorship, making changes to your facilities, all those types of expenses. But the really critical piece is to remember that it cannot be used to cover lost revenue. It can only be used to cover expenses. The other layer of complexity with particular note for the nursing home infection control is if you are a nursing home that received that distribution as well as a general distribution, say from phase 3, you do really need to track how those were used separately, because there are different eligible uses. The other piece in managing targeted distributions that presents a lot of complexity, again, particularly if you are a parent entity that had a subsidiary receive a targeted distribution. While the targeted distributions could be effectively signed over to a parent entity, the entity that received the targeted distribution has to be the one that reports. So even if that targeted distribution was really controlled by the parent organization, the subsidiary that was eligible for and received the targeted distribution has to report, which I realize can introduce a lot of complexity depending on how you handled those funds across your enterprise. The other important piece is the expenses or lost revenues assigned to this targeted distribution cannot also be reported by the parent entity. So if you have a sub that received a nursing home infection control distribution, those nursing home infection control expenses, let's say testing expenses, cannot also be counted by the parent for the purposes of taking advantage of the parent's general distribution payments. So again, a lot of complexity in managing there. Very important to have all of your documentation very clear and very very available, as that is likely to draw some scrutiny from HHS. Okay, so reporting components. Again, for those of you who reported in the fall, this is going to be some review. But for those of you who are new, this lays out the major categories of reporting. The first section is really organizational information. It's pretty straightforward. The second section, fund use information, is sort of the meat of it, how the information that's going to allow you to justify claiming the full amount of the funds. And then the final piece is operational information, which is not contemplated in terms of your ability to keep the funds. It's more of information finding for HHS. However, we're going to talk about that it's important not to discount the amount of effort that that section can take. So going back to the organizational information, straightforward registration, basically entering your contact information and tax IDs. There is a subsidiary questionnaire. You'll be reporting on your subsidiary TINs, as well as whether you acquired or divested of any subsidiaries during the reporting period. If you don't have any subsidiaries, then this will not apply to you. You'll just answer no and you'll be able to move on. And then the next piece, you'll report on any interest earned on the payments if they were held in an interest-bearing account. If they were not, then you don't need to worry about it. Single audit status, which Amber will talk more about later, and other assistance received. For many providers, the other assistance received is really just your PPP loan. Though HHS has noted in the updated reporting guide that your Medicare accelerated and advanced payments should also be noted under other assistance received in the other category. There's not a specific call out for your Medicare accelerated and advanced payment. So going on to the fund use information, the first chunk of reporting you will do is about the expenses due to coronavirus. So kind of the first way you're claiming the funds is to cover the incremental expenses due to COVID. Depending on the amount of money you received, you may see one of two different tables. The first table, if you received under $500,000, you're going to report in two broad categories: general and administrative and healthcare related. You are going to report on a quarterly basis, so Q1 20 through Q4 2021. Again, these are incremental expenses due to COVID. If you receive over $500,000, you'll report on a much more detailed level. What tended to confuse folks in the previous reporting period is the examples of some of the expenses provided were categories of normal operating expenses like rent, etc. It is not asking for your normal rent that you would have incurred had there been a pandemic or not. They are looking for incremental rent. So for example, if you were a hospital that rented a hotel in order to provide extra beds, that incremental rent of the hotel would be eligible. Your normal rent would not be. And that goes for all other expenses. So you always bought some amount of PPE. It's not your normal amount of PPE. It's the increment over and above, either due to the volume that was purchased or the incremental cost due to the kind of price gouging that was happening during the pandemic. For the expenses, that table will only allow you to enter expenses up to the amount of the payment you received. So for example, if you received $100,000, it is only going to let you enter $100,000 of expense. If you have expenses over and above the amount of the PRF payment you received, those incremental expenses are entered in the next bucket, unreimbursed expenses. Now, for most outpatient providers, including dental, et cetera, the minority of your provider relief fund payment is going to be claimed as expense. Most of it is going to be claimed as lost revenue. So for most providers, you will not need to enter anything in this unreimbursed expense category. You will enter some amount of incremental expense up here, and then the remainder of the payment is going to be claimed in lost revenue. Speaking on lost revenue, there are three methodologies for calculating lost revenue. The most straightforward by far is the first one, which is an actual to actual comparison. So that is comparing 2019 by quarter to the corresponding quarter in 2020 and the corresponding quarter in 2021. 2019 is always the baseline. What can be complicated here is the lost revenue grid that you will need to fill out requires that you break your revenue down into categories. And those categories are Medicare Part A and Part B, Medicare Part C, Medicaid and CHIP, self-pay, which they are defining specifically as no insurance, commercial insurance, and other, which might be another government payer, for example. For many providers, your billing or revenue systems may not track in precisely those categories. So that is something that tended to take a lot of time for providers in phase one. So it's really important to get into your system, figure out what categories you can map from the HHS reporting into your system to make sure that you're able to kind of make your best effort at matching what they're asking for. There are two other methodologies for calculating lost revenue. The second is a budget to actual. Unfortunately, I have yet to see anyone who's been able to take advantage of this. You had to have had a budget established and approved before March 27th of 2020 that would cover the entire year 20 and the entire year 21. So unless you had that handy, you won't be able to use the budget to actual comparison. And then the final methodology, option 3, is to come up with an alternative methodology, which they will allow you to come up with whatever methodology you think best captures the economic injury to your practice. We have done this with a number of providers for a number of different reasons. It does place you at a higher risk of scrutiny, higher risk of audit from HHS. But depending on your unique facts and circumstances, there certainly are cases where it can make a lot of sense. Just as a quick example, if you added 20 providers in January of 2020 and your revenue may have gone down on a per provider basis, but revenue overall was up just because you had more providers. That would be an example of the type of situation where it might make sense to use an alternative methodology. So again, those 3 elements, expenses, unreimbursed expenses, and lost revenue, are how you're claiming the funds. But there is a final section, personnel, patient, and facility metrics, that has to be completed in order to complete reporting. Here, you're reporting on headcount of personnel in a number of different categories, your patient encounters, inpatient admissions, ED visits, outpatient visits, and facility stays, and then facility metrics. Facility metrics, that's only going to apply to you if you operate a facility, nursing homes, hospitals, et cetera. Patient metrics, most folks are looking at outpatient visits if you're an outpatient provider. However, if you do admit patients to the hospital, different situation. And if you are a hospital that has both inpatient and ED, there's more complexity there as well. The personnel metrics, the categories for the personnel metrics, the way HHS has defined them is not how many HR systems may define full-time, part-time, et cetera. So what we found in the first phase of reporting back in the fall, getting those numbers together took a very long time. So while a lot of providers were really honed in on making sure their expenses and lost revenue were going to allow them to capture the full amount of their payment, and then kind of left this operational information to the last minute, that caused a lot of heartburn. So I would not discount the amount of time it may take you to pull together this last piece. But those are the components of reporting. We do have, and we're happy to share, they're in the appendix for these slides, so we'll send these out afterwards, full definitions for the expense categories, the personnel categories, et cetera, which will likely be helpful. But again, can't stress enough that the more time you give yourself to pull this together, the less stressful it will be. There's also a workbook we can share that kind of mimics the portal. It does not need to be submitted, but it's sort of scratch paper where you can pull your information together. For folks who did that last time, it took them like 20 minutes once they were in the portal to get everything done. So really recommend pulling everything together in advance if you can. And then 2 tactical notes. Number 1, if you have any cells that don't apply to you, so let's say you didn't have any healthcare related expenses, you only had G&A expenses, you can't leave any cells blank. So if anything doesn't apply to you, you have to put a 0 in, or else it's going to throw an error. The second note, the portal does have save functionality. So you can save a completed page, close out, and come back later. You do not need to get it done in one sitting. Okay, phase 4 and ARP. Many of you may have received phase 4 payments already. As I noted, there was an application process in the fall that closed, I believe, at the end of October. If you have not received anything and you also have not gotten a letter from HHS saying that you will not be receiving anything, it's likely that your application is still in process. So I would not give up hope just yet. We have heard of people continuing to receive distributions. If you have already received a payment, there is a reconsideration or appeals process. They had a similar process for phase 3. What this process allows for is if you believe that the payment you received was inconsistent with the published distribution methodology, meaning you believe that they calculated your phase 4 payment wrong, you can submit a reconsideration request. Now, the complexity here. The distribution methodologies are fairly straightforward. However, there are key pieces of information that you would need in order to back into what you quote unquote should have been paid that we do not currently have. So at present, there is not enough information out there to accurately even take kind of a swag at what you should have gotten. There are ways where you can sort of triangulate a ballpark, but unfortunately, the appeals process is not a 0 risk. I'll just throw my hat in the ring. Maybe I'll get some more money. If you submit and HHS unearths an overpayment, they are taking the position that they can claw that overpayment back. So our guidance at this point is to wait and see. You have until May 2nd in order to submit a reconsideration request. They did publish all of the information that was necessary to do your calculation for the phase 3 reconsideration process. So we're hopeful that they will do the same here. Phase 4 and ARP rural payment use. So in terms of the eligible uses for these payments, it's the same as the other general distributions, incremental expenses, and lost revenues due to COVID. For payments that were received in the fall, so November, December 2021, those payments can be used until December 31st of this year, 2022, with a reporting deadline of March 31st of 2023. HHS has not actually published updated deadlines and reporting periods, but if they're going to keep following the same pattern, anyone who received payments in January, February of this year would presumably have until June 30th of next year to take advantage of the payment and would have a reporting deadline of September 30th of next year. Important note on the ARP rural payment. Unlike the general distribution payments for the PRF, the ARP payments cannot be transferred to non-rural TINs. So for example, again, if you're a parent entity, say you had one subsidiary that received a sizable rural payment, you cannot take control of that money and distribute it out to other subs or other uses. It has to stay with the TIN that was eligible to receive it. The other piece to bear in mind, as the pandemic has evolved, providers are not incurring the same levels of lost revenue and increased expense that they once were. We have seen some providers receive very sizable payments from phase 4. So it's very important to be thinking about, am I going to be able to claim the full amount of this payment? This is a kind of a high level example, a provider that as of 2020 had $100,000 in PRF payments, $7,000 in eligible expenses, and like $225 in lost revenue. In that example, no concern about claiming the full $100,000. However, they then received $200,000 in December of 2021. So they're now looking at, well, maybe we'll have an incremental $2,000 in estimated expense for 2022. Maybe based on how Omicron went, we might be down $10,000 in lost revenue, but we're left with this like $56K delta between what we think we'll have for eligible uses and the payment we received. The important thing, it's obviously very early in 2022, is to get a handle on where you are versus the amount of money you've received. Do you have enough uses already incurred, or do you need to start thinking about, okay, how else might we take advantage of this money? Top of mind for everyone, of course, staffing. These funds can be used for expenses like retention bonuses, hiring bonuses, unplanned overtime, fringe benefits like childcare or transportation. So if you are in a position where you're thinking you may have some kind of delta, and again, it's very early in the year, it's really just something to track at this point, those are the types of expenses that you could start thinking about just to ensure that you're able to claim the full amount of the payment. And with that, I will turn it over to Amber, though I think we have one quick question.
There's actually two in there, Kate. So the first one being, would you recommend waiting closer to March 31st in case of changes, or is submitting now okay?
Submitting now is fine in terms of submitting for the reporting. If you have everything together, you feel confident and everything, we don't anticipate any changes to the reporting portal, especially since we've already been through reporting once. So if you've got everything sorted and you're ready to submit, you can go ahead and submit and move on with your life.
And the second piece to the question is, can you speak to a little bit about selling practices? So in this instance, there was a sale of a dental group in April. Does that have an impact? Received minimal dollars and submitted proof of loss of revenue?
Yeah, so the transactions with all of this, there is complexity there. To give you the right answer, we would need to know more about kind of the facts and circumstances of the transaction, how it was structured, et cetera. We'll have our emails and phone numbers up at the end of the presentation and can send those out as well with the slides. But generally, it depends on how control changed. So most likely, you know, as long as you're checking the right boxes, you should be okay. But there is a lot of complexity there, and you do want to make sure that that you followed everything accordingly.
Great, thanks, Kate. So as far as audit considerations are concerned, a couple of these things are going to be audit reminders for those who have listened in on to our webinars before that Kate and I have done on these funds. But the reason why we wanted to bring this back up is for a lot of providers, for 12/31/21 year ends, this is the first time that they will have to report or undergo a program or single audit of provider relief funds. So as a general reminder, providers who expended $750,000 or more of provider relief funds are required to undergo one of these types of audits. When I say expended to, I just want to be clear, that does include lost revenues, as Kate mentioned previously. So taking all of those incremental COVID expenses plus lost revenue into account, then factors into the threshold itself. So basically, as I mentioned, the providers that have fiscal year ends of June 30th, 2021 or later have to undergo these audits. The audits are due the sooner of 30 days of issuance of general audited financial statements or 9 months after year end, whichever is sooner. So for providers that have a fiscal year end of December 31st, 2021, you're really reporting on the CFA, which is the Schedule of Expenditures of Federal Awards from periods 1 and periods 2. So that's payments received and utilized for lost revenues from April through December 31st of 2020. Basically, it's a year behind. You could go to the next slide, Kate. So as far as a single audit versus a program audit, as I mentioned, both of those, basically this audit is a 2 Code of Federal Regulations, CFR Part 200 audit, otherwise known as Uniform Guidance Audit. And it's required is if your organization expends more than $750,000 in federal awards during the year, or as I mentioned on the previous slide, during those periods. It's also important to review any other federal contracts that providers may have, because certain contracts, even though you don't expend close to $750,000, could be mentioned in the contract itself that the audit is still required. So really what you want to do is look at all your sources of federal funding. And as a reminder, this does not include PPP funds, so you can take those out of the picture. But any other federal funds that the organization receive, and take those into account to whether you meet that $750,000 threshold. The next step, if you do meet that threshold, is to determine whether you can qualify for a program audit or if you have to undergo a full-blown single audit. A program-specific audit is allowed when there's one federal program or funds expended under one federal program, and when conditions of the federal award don't dictate that you need a full-blown single audit or GAAP financial statement audit. A single audit is required when more than one federal program has funds expended under it. So with that being said, if there were state pass-through funds, we're seeing a lot of providers that received some funds through the state, as well as the funds through provider relief funding or HHS. In that case, the single audit is required and a program-specific audit is precluded. If the organization expends less than $750,000, then you don't even need to evaluate this part and you're exempt from audit requirements for that year. Go ahead, Kate. So just some general auditing responsibilities. We wanted to go over these just because we understand that for a lot of providers, you had never had to undergo these types of audits before. And there are some responsibilities that you are required to go through if you do have one of these audits. So the first one really being that you need to procure or arrange for the audit as required under 2 CFR or uniform guidance with auditor selection, and ensure that the audit itself is properly performed and submitted and when it's due. So in requesting proposals for audit services, the objectives and scope of the audit have to be made clear, whether it's program, single audit, whether the entity the entity also must request a copy of the audit organization's peer review report. The auditor is required to provide that under generally accepted government auditing standards. So when you're going out to bid or going, looking for an audit request for these types of audits, you must request that. Factors you want to consider in evaluating a proposal for these types of service include responsiveness to RFP, relevant experience, availability of staff with professional qualifications and technical abilities, and the results of those peer review reports. Now, this one is key because there are a lot of audit organizations out there, but not every one of those accounting organizations have staff with the professional qualifications to complete these types of audits. So you want to be clear in your RFP and also evaluate the responses to the proposals to make sure that staff do have those qualifications. And then also just another note here, an auditor who prepares the indirect cost proposal or a cost allocation plan may not also be selected to perform the audit. This is probably not applicable to a lot of you providers, but just something we did want to mention here as well. Go ahead, Kate. All right, so a couple other responsibilities. The second one being you need to prepare appropriate financial statements, including the schedule of expenditure of federal awards or CFA, in accordance with uniform guidance. What I did here was just posted a snapshot of what a CFA would look like, which shows not only provider relief funds, but also funds that were passed through the state for some providers here in Rhode Island. The next one being that an auditee is responsible for promptly following up and taking corrective action on any audit findings, including preparation of a summary of schedule of prior audit findings, if there were any, and a corrective action plan for current year findings that really goes through the audit findings itself, the follow-up, and how the auditor, how the client itself plans to rectify the issues that were found. And finally, the last key just being providing the auditor with access to personnel, accounts, books, records, supporting documentation, and other information as needed for us to perform the audit itself. So this is key, as Kate mentioned a few times, is really making sure that you're keeping track of all the funds, whether it be a targeted distribution or a specific or a general distribution itself, and how you're utilizing each of those funds individually. Especially when it comes into play with infection control expenses and making sure those are separated from the rest of the expenses used for general distributions. So as far as testing requirements are concerned and what the auditors will look at in testing these types of funds, first being activities allowed or unallowed and overall allowable costs. As Kate previously mentioned, the costs itself are incremental COVID costs. So those examples include, supplies, equipment, workforce training, test results, things of that nature. If you utilized it for bonuses and payroll, those types of expenses are the expenses that auditors will test when it comes to testing this program itself. Also, on the reporting side of things, auditors are required to test that reporting that was completed in the PRF reporting portal for all periods covered under the CFA. So for all organizations that have 12/31/2021 year ends, this covers period 1 and period 2 reporting. So period 1, while that's already complete, period 2 is in process for some providers now. That reporting is still covered under the audit, so the audit itself cannot be finalized until that period 2 reporting is complete. Now, what we're hearing from a lot of providers is some did not take copies of the reports or did not take screenshots as they were reporting into that portal. This is something you're going to want to get ahead of and call the HHS help hotline and work with them on getting a copy of that report, as it is a key for the audit itself if you're undergoing a program or single audit. And the final part being for testing requirements under the audit is special tests and provisions. So under the terms and conditions of the award, the organization itself had to go in and certify that it would not seek to collect from the patient any out-of-pocket expenses in an amount greater than what they would have been required to pay if they had been provided care by an in-network provider. And that's for patients with presumptive or actual cases of COVID-19 from January through the present. And of course that falls under balanced billing testing as well. So if that were the case and the provider were doing that, there would be special tests that the auditor would need to do to work with the client to make sure they're meeting those conditions. So overall, we are very happy that you were able to join us today. We did end a few minutes early. If there's any questions, you can please submit them through the Q&A section of this. But Kate and I are here for any other questions that may come up. As you can see our contact information on the screen. We're more than happy to get on a call, answer any questions that come up, whether it be with reporting, with audit requirements, or any other thing that regards the provider relief funding itself.
Yeah, thank you everyone for joining us. And as I mentioned, we'll be sending the deck out, which hopefully will be helpful to everyone. But unless there are any questions, we can give everyone back 15 minutes of their lunch hour and hope everyone has a great day. we do have a question. Are audits required if the grant was less than 500K and no other funds were received?
No, a single or program audit is not required if it was less than $500,000. The threshold is $750,000. And to be clear, as far as a single versus program audit, a program audit would just be an audit of the provider relief funds itself. If the organization does have to undergo a full-blown single audit, it is all of the organization's activities, meaning a full financial statement audit is required at that point.
Okay. And should ERTC credits be considered when accumulating federal funds greater than 750K for the audit requirement?
That is a great question. And just like PPP funds, ERTC credits are not included in that $750,000 threshold.
All right. And is the 750K combined awards or individual?
So this is for all of the periods that you have received funds through. So period 1 through 2 is for December 31, 2021 year ends. So if you received more than $750,000 in those 2 periods, then that is when you're required to do the further evaluation of single versus program audit.
And a similar question, if you receive 2 tranches of funding, are they treated as separate amounts for PRF for reporting? It depends the period in which you received the funds. So for example, if you got a payment, 2 payments in the second half of 2020, like let's say you got one in September and then one in December, that would all be kind of amalgamated together for the period, for the purposes of this reporting period. Now, if you had gotten a payment in the first half of 20 and then a second payment in, December and January, so that's going to be 2 different reporting periods. So you'll report in this period for the payment you received in December, then you will need to report again in the period that will open July 1st of this year and close September 30th of this year on the payment you received in January, because those are 2 different payment received periods.
And just like Kate with the reporting on the audit side of things too, it also depends on when you received the funds. So for providers that received funds in December for phase 4, for example, that would be included in the December, the current year audit. But providers that received the phase 4 funds in January then kicks into the next year. So it all comes back to when the period or when the funds were received.
Mm-hmm. All right. Well, if we don't have any other questions, again, feel free to reach out to us. Happy to answer anything else that might pop up as you're continuing to think about this. But as we mentioned, the #1 thing to bear in mind is just getting this done as early as you can. There were a lot of stress and a lot of late night calls back in September. So highly recommend doing things as early as you can.
Thank you, everyone. Have a great day.
Thank you.